Hello guys, so today we're moving to May-June 2016 FAC 1502. So in May-June 2016 we're going to do question number A and question number B. A, it says prepare the statement of financial position of Cayenne Corp as at 31st of July 2017. And question number B is about PPE, property, plant and equipment. So now the thing is, you cannot do the statement of financial position without doing the PPE. So you need to start by calculating the PPE, and then the value of PPE, you will then use it on the statement of financial position. So let's start with question number B. Question number 2B of PPE. Prepare the note for property, plant and equipment of Cayenne Corp for the year ended 31st of July 2017. The total column can be omitted, so you don't have to put the total column. So this is the format of doing the PPE. This is the format. So we need to calculate the current amount at the beginning. So the beginning of the financial year, since the end of the financial year is the 31st of July 2017, so the beginning is the 1st of August 2016. So what you're going to do, how do you calculate the current amount at the beginning? So the current amount at the beginning is the cost price at the beginning minus the accumulated depreciation. So this is how we do it. So in our information, first of all, identify how many non-current assets have you been given here. So in our situation, we only have a vehicle as an example of non-current asset. So that is why I only have one column representing vehicles, because I only have vehicles as an example of non-current asset. So what am I going to do now? I'll be like, okay, what is the cost price of the vehicles at the beginning of the year, and what is the accumulated depreciation for the vehicles at the beginning of the year? And now they come and say vehicle at cost on the 1st of August 2016, it was 50,000. And then the accumulated depreciation for vehicles at the 1st of August 2016, it was 23,000. So now you're gonna say the cost price for the vehicle is 50,000. 50,000 minus the accumulated depreciation at the beginning, it was 23,000. So this is how you calculate the carrying amount at the beginning of the year. So the carrying amount at the beginning will be 50,000 minus 23, so it's gonna be 27,000. So this is how you calculate the carrying amount at the beginning of the year. So let's move to additions. Let's move to additions. What are the additions? Additions simply tells or refers to the non-current assets that were not there at the beginning of the year, but these non-current assets, they were purchased during the year. So since we have a vehicle here, so it means on addition we're talking about the vehicle that was purchased during the year, and that vehicle, it was not there at the beginning. So what is that vehicle? So let's have a look on our information, additional information number 7. On 31st of August 2016, Cayenne Corp sold their delivered vehicle to Mr. Doolittle for 15,000 cash. The proceeds from this transaction was used to help finance the purchase of another vehicle on the same date from Big Brothers Motors for 30,000. So there is this purchase of another vehicle from Big Brothers Motors for 30,000. So this vehicle of 30,000 is an addition, because this vehicle of 30,000, it was not there at the beginning of the year, but it was purchased during the year. So you'll come here and say we have addition of 30,000. 30,000. So this is how you do it, okay? And then let's talk about disposal. So disposal here, we're talking about the vehicles that were there at the beginning of the year, but they were sold during the year. So at the beginning, this vehicle were there, but during the year they were sold. So let's look at the vehicle that was disposed here. So if you come back to additional information number 7 here, on the 31st of August 2016, Cayenne Corp sold their delivery vehicle to Mr. Doolittle for 15,000 cash. So it seems like we have a vehicle that was sold for 15,000. But there is something. If you look down here, they're saying the cost price of the vehicle sold was 21,000, and the accumulated depreciation amounted to 12,000 at the 1st of August 2016. So the cost price of a disposal is 21,000. So you'll come to your disposal. Disposal is what you sold during the year. And then how much was the cost price? It was 21,000. So they said it's 21,000. So cost price is 21,000. And how much is the accumulated depreciation? They said the accumulated depreciation of the disposed car, it was 12,000 on the 1st of August, and this car was sold on the 31st of August. So if you have to look, our financial year is starting on the 1st of August, and the car was sold on the 31st of August. So this car was 1 month old. So for that 1 month old, we want to see how much did that car depreciate with. So we need to calculate the depreciation. So on number 8, they say depreciation on vehicle is 20% per annum, okay, using the diminishing method. So if you use diminishing method, it's what's the formula for diminishing? It's cost price minus accumulated depreciation. Okay, bracket cost price minus accumulated depreciation times 20% over 100. Okay, so this car at the beginning it has a depreciation of 12,000, and then at the end of month it was sold. So this car survived 1 month, so you will be like times 1 over 12. And then how much is gonna be the depreciation for that 1 month? So the cost price is how much? The cost price here, it seems to be like 21,000 minus accumulated of 12,000. At the beginning the car is an accumulated of 12,000, and times 20 divided by 100 is 0.20 times 1 over 12. So you'll get 150. So 150 will be your depreciation for 1 month, because this car was sold at the end of August. So for August the car depreciated by 150. So now on your accumulated depreciation of disposal, you're gonna have to come and say at the beginning it was 12,000, and then it was sold after a month. So after a month it depreciated by 150. So the overall depreciation is 12,150, and then depreciation is always in brackets. You then subtract the 2. So that's how we do it. You subtract the 2. How much will you get? 12,000, 21,000 minus 12,150, you'll get 8,850. So you're gonna get amount of your disposal is cost price minus the accumulated depreciation. So it's gonna be 21,000 minus 12,150, you get 8,850. So this will be your disposal. Okay, let's move to depreciation. So depreciation is a very broad topic. We need to calculate basically 3 things. Okay, let's see how we calculate depreciation. So what are we going to do? We're going to calculate depreciation of the vehicles using the 20% on diminishing method. So the thing is, we must calculate 3 kinds of depreciation. We must calculate for the existing vehicle, we must calculate for the new vehicle, we must also calculate for the sold vehicle. So we're going to calculate 3 of them. Okay, so now these are the steps. So you have step number 1, step number 2, and step number 3. So now for the existing vehicle, remember when you started the financial year, you had the vehicles of 50,000 at the beginning of the year. Okay, so because you sold the vehicle of 21,000, so the existing cost price of the vehicle is no longer 50,000. So you must subtract the cost price of the sold vehicle. So now the cost price of the existing vehicle is going to be 29,000. The same applies with the accumulated depreciation. For the existing vehicle, initially the accumulated depreciation was 23,000. But because you sold a vehicle that has a depreciation of 12,000, so it means you must subtract 12,000 because 12,000 has been disposed. So the 12,000 is no longer existing. So it should be subtracted and you get 11,000. So as the formula is saying, cost price minus accumulated depreciation. So now the cost price for the existing is 29,000. Accumulated depreciation for the existing vehicle is 11,000. After you subtracted the cost price of the disposal and the accumulated depreciation of the disposal from the cost price of the beginning of the year, and then you multiply with 20%, and then you get depreciation of 3,600. So remember we bought another vehicle, so the new vehicle that was purchased during the year is for 30,000. So what are you going to do now? You will be like, okay, the vehicle costed 30,000, but because it was purchased during this year, it hasn't accumulated any depreciation. So it's going to be 30,000 minus 0 times 20% times 11 over 12. So this car was purchased on the 31st of August. And then that's where our financial year started. So we'll be like, okay, our financial year started on the 31st of August. On the 1st of August, and the car was purchased on the 31st of August. So now, how long did this car survived during the financial year? So that's what's gonna happen. You'll be like, okay, the car was purchased on the 31st of August and we closed our financial year on the 31st of July 2017. So it means the car survived 11 months. So it will be 11 over 12. Then you do the calculation, you'll get 5,500. What about the sold vehicle? So the cost price for the sold vehicle is 21,000. At the beginning of the year, the accumulated depreciation for the sold was 12,000 times 20% times 1 month. So the sold vehicle for that financial year, the sold vehicle only lasted for a month. So that's why we have to say it's 1 over 12, because we started the financial year on the 1st of August 2016, and then the car was sold end of August 2016. So it means that car lasted a year. Now you get 1/5. So now you add all these depreciations. So you'll come and be like, okay, how many depreciations do you have? You have 3 of them. You have, for the existing vehicle is 3,600 plus the new vehicle is 5,500 plus the sold vehicle is 150. So if you add all of them, how much will you get? You'll get depreciation of 9,250. So you'll get a depreciation of 9,250. 9,250. So the amount of depreciation here will be 9,250. Now let's move to the carrying amount at the end of the financial year. So how do you get the carrying amount at the end of the financial year? We'll say cost price at the end of the financial year minus the accumulated depreciation. So when we started the financial year, we had a cost price of 50,000. So this is how we calculate. So we had a cost price of 50,000 when we started the financial year. And then during the year, we added a vehicle of 30,000. So now we have a cost price of 80,000. But during the year, we also sold a vehicle which we disposed of 21,000. Remember, we sold a vehicle of the cost price of 21,000. So 21,000 should be subtracted because 21,000 is no longer existing. So now at the end of the year, how much cost price are you remained with? So at the end of the financial year, it seems like we remained with a cost price of 59,000. So you'll come and say 59,000 by saying 50 plus 30 minus 21,000, you get 59,000. So this is how we do it. And then what about the accumulated depreciation at the end of the year? So at the beginning of the year, accumulated depreciation was 23,000. And then during the year, you got a depreciation of 9,250. And then you also sold a vehicle. So the vehicle that you sold, it has an accumulated depreciation of 150. You have 12,150. So it will be minus 12,150. So if you do the calculation, how much will you get? You'll get 20,100. 20,100. And then 59,000 minus 20,100, you'll get the carrying amount at the end of the financial year of 38,900. So the carrying amount is 38,900. So this is the value for what? This is the value for PPE. So when we're going to do the statement of financial position, we'll use this amount for PPE. So this is how you do everything. So you can replay the video several times. So now I'm going to continue on the same video with question number 2A. So let's do question number 2A. So this is how we do the statement of financial position. So we're gonna start with assets. On assets, we have non-current assets. Non-current assets have two things, which is PPE and fixed deposit. So now, how much did you get on PPE? So the value for PPE, it was how much? PPE, it was 38,900. So our PPE is 38,900. So you'll come here and say non-current assets PPE is 38,900. So it's 38,900. So this is the value for PPE. And what else do we add on non-current assets? We also add the fixed deposit. So you come to your question here. Do we have the fixed deposit? It seems like we do have the fixed deposit of 100,000. We have the fixed deposit of 100,000. So it's gonna be 38,900 plus fixed deposit of 100,000. So how much will you get if you add 38,900 and those fixed deposit? So you'll get 138,900. So if you add the two, you'll get the value of non-current asset. So you go along this row of non-current assets. So you'll get 138,900. So this is the amount of non-current assets. So let's move to the current assets. Okay, so on current assets, we basically have to look at a lot of things, okay? Let's have a look on the non-current assets. Since we're now done with the non-current assets, let's do the current assets. So the current assets, will start with the inventory. So now you'll be given two kinds of inventory. The other part of inventory is the inventory at the beginning of the year, and the other part is the inventory at the end of the financial year. So when you're doing the statement of financial position, we basically use the inventory at the end of the year. So now, if you look at our information here, we have this inventory here. We have trading inventory on the 1st of August of 58,000. We also have stationery on the 1st of August of 5,600. But the thing is, we don't basically focus on them. We focus on the inventory at the end of the financial year. Okay, let's have a look here. On the 6th of on additional information number 6, on the 31st of July 2017, stationery on hand amounted to, so stationery, packing material, consumables and inventory form one thing. Okay, all of them we call them inventory. So the stationery at the end of the financial year is part of inventory. So you're gonna come here and say you have 6,500 plus. And then what else do we have? Stationery at the end of the year, 6,500. We also have the packing materials on the 31st of July amounted to 3,000. So the packing materials is also what? The packing material is also part of inventory. So we take 3,000, we add it here. At the end of the financial year, the packing material was 3,000. Do you still have any other inventory here? Number 11. An inventory count on the 31st revealed that inventory amounting to 33,000 was on hand. So on the 31st of July, we have inventory of 33,000. So we have another one of 33,000. So it will be plus 33,000. You close the bracket. So this is how you do it. And then you add everything. So if you add everything, how much inventory will you get? You'll get 42,500. So if you add these things, you'll get 42,500. So let's move to trade receivables. So now here is my question. How do we calculate trade receivable? Trade receivable. So trade receivable is basically debtors. Is debtors plus what? So debtors is the same as trade receivable. Is debtors plus accrued income. Accrued income. Minus what? Minus written off credit losses. Okay, so it's like we have trade receivable here of 40,000. So it's gonna be 40,000. This is our debtors balance. So it's 40,000 plus. Do you have accrued income? Okay, I read something here about the inventory. They said the inventory valued at 10,000 was stolen in a breaking at the business premises. Insurance settlement amount of 80% on the value of the inventory and is due to be received on the. So insurance is to pay 80% of 10,000. So 80% of 10,000 is how much? It's actually 8,000. Yes, it's 8,000. So now insurance is paying. So it's when insurance pay, it means it's an what? It's an accrued income. It's another example of accrued income. So now you're gonna say it's 40,000 plus 8,000, because 8,000 we get it by saying 10,000 times 80%, so times 80 over 100. This is how we get this 8,000. So how much will be your trade receivable? Will be 48,000. So your trade receivable will be 48,000. So our trade receivable is 48,000. Okay, let's move to cash and cash equivalents. Okay, so cash and cash equivalents is bank plus petty cash plus cash float. Okay, so now we have a lot of transactions that affects cash and cash equivalents. We have a bank of how much here? It seems like we have the bank favorable balance is 67,987. So bank is 67,987. Okay, so this is our bank balance, and it seems like we also have the petty cash here. Okay, I've seen petty cash around here. Deposit water and electricity. A deposit of water and electricity. So this amount of money is a petty cash of 1000. So we need to add the petty cash 1000, and then we also have the interest earned on current account. So if the bank earn interest, it means it gets money. So also have 187 here, we add it. Okay, and then we have few things to subtract. So like they're saying, we have bank charges of 1480. So you need to subtract 1480, the bank charges. You also have to subtract what? Like here they said check number 1248 for stationery purchase was entered in the cash payment journal as 1237 instead of 1273. So you paid by a check, but you understated your check because you're supposed to pay 1273 and instead you paid 1237. So the bank is still owing here. So how much does it owe? So you must subtract the two. 1273 minus 1237, you'll get 36. And then this plus this plus this minus this minus this, how much will you get? So let's do the calculation and see how much will you get. So if we do the calculation, we'll get 67,658. So we'll get 67,658 if we add all of them and subtract. Okay, let's do the prepaid expenses. So I've seen a prepaid expense here of insurance. On number 3, an annual insurance premium of 13,500 was paid on the 1st of October. So 13,500 was paid on the 1st of October 2016, and it was an annual. So our financial year started on the 1st of August 2016. So it's gonna be August, September, and they paid on October. So it means this insurance, it was for 12 months. So if we count from October till the end of the financial year, is 10 months. So to make it 12 months, we need to go further to extra 2 months. So how are we going to calculate this one? So we're going to say the insurance is how much? Insurance is 13,500 times 2 over 12. So they prepaid for extra 2 months. Okay, so how much will you get? So it seems like you get 2,250. And then we also have another prepaid insurance here. Okay, they said on number 10 here, the inventory of 10,000 was stolen. So the insurance was due to be received on the 21st of August 2017. And remember, our financial year is closing on the 31st of July. So this insurance, it was also a prepaid insurance. So 10,000 should also be added. So on insurance, you'll come and say prepaid expense, we have 10,000 plus how much? Plus 2,250 plus 2,250. And then how much will you get? You'll get 12,250. So now these are all your non-current assets. You need to add them. So if you add all of these non-current assets, how much will you get? You will get 170,408. You'll get 170,408. So now to get the total of assets, we must say current assets plus non-current assets. So current assets is 170,408 plus 138,900. So how much will you get for the total assets? So total assets will amount to 309,308. So will amount to 309,308. So this will be our total assets. Okay, now let's move to equity and liabilities. So equity and liabilities, we'll do them to another video for the sake of space. Okay,